Let us understand the difference between return on equity and return on asset. Have a look at this balance sheet. In this business, owners have contributed a capital of 10 crore. Business has already made profit that got retained, that is 15 crore. And business has also borrowed money from outsiders. I call it as OL, which stands for outside liabilities, and that is 75 crore. So they have mobilized overall funds of 100 crore. And they have used those funds for creating current asset and fixed asset, and put together is 100 crore. Let us also have a look at their profit and loss. This business is making a sales of 100 crore annually. They are incurring various expenses. Let's say the operating cost, that is around 60 crore. So you have 40 crore profit. I call it as profit before interest and taxes. Let's say they have to pay interest at the rate of 10%, assuming the other liabilities are loans. So on 75 crore, they have to 10%, which works out to 7.5 crore. It means they are left with 32.5 crore, and this is their profit before tax. So on this, they have to pay taxes. Let's say tax on this works out to 10 crore. It means profit after tax is 22.5 crore. So what is our agenda now? Our agenda is finding out return on equity and return on asset. Return on equity means we are trying to measure the return available for the owners. See, owners have contributed two type of funds. One is capital, which is their direct contribution, and the reserves and surplus are their indirect contribution, because they allowed profits to be retained within the business. So their total investment is 25 crore. For having invested 25 crore, what is the return they are getting? It is basically this profit after tax. So profit after tax divided by equity, which is nothing but the sum of capital and reserves and surplus, gives the return on equity. I'll put it here. Return on equity is equal to 22.5 divided by 25, which is 10 plus 15, and it is whopping 90%. Okay. Then what is return on asset? Return on asset means we will be comparing the total asset with some profit. But the question is which profit? For that we have a rationale. Let us see how this 100 crore asset was created. This 100 crore asset was created using 100 crore funds. And this 100 crore funds have come from owners and outsiders. So if you want to measure the return available for these two parties, you have to see the profit which contributes for both of them. If you are considering this profit, it is wrong because it contributes only to the owners. If you are taking this profit, still we are wrong because it is not contributing anything for outside liabilities. So what is ideal here is this profit, because using this 40 crore profit, you can pay interest, right, which is the reward for the outside liabilities. Then using this profit, you can also pay owners, which is the reward for the capital. Okay. So the most appropriate measure or profit is PBIT. So let me put that here. Return on asset is PBIT divided by total asset. And here PBIT is 40 crore. Total asset is 100 crore. It means this business is generating return on asset of 40%. But look at the return on equity. It is huge at 90%. It's because this business is highly leveraged. They have high debt in their capital structure, which carries a fixed cost, and their stake is very low, let's say at the rate of 25% of the total funds. So of the 40 crore, after paying the fixed cost and taxes, the leftover profit is a handsome reward for the owners, and it stands at 90%. And here we go. Credit and Financial Analysis Mastery course. It's a comprehensive pre-recorded online course that comes with 15 modules of video lectures, basically 70 plus hours of video contents, multiple ebooks and reading materials related to credit and financial analysis that will make up another 30 plus hours of content. So totally it is 100 plus hours of learning resources. Then you will also get access to a private community in Telegram for clarifying your doubts in credit and financial domain. Then you also have the flexibility to choose 1-year subscription or lifetime subscription depending upon your learning goals. So by joining this course, you will learn basics of credit analysis, how to read balance sheet, financial ratio analysis, cash flow, fund flow analysis, how to arrive at credit risk rating, how to prepare CMA report, cash budget, how to assess credit facilities like CCOD, LC, BG, term loan, how to write bank loan proposal, and you will also have access to case studies related to credit analysis. So to join this course, to know more about the course, comment CFA, and I'll share the details with you.